Hello there. In this video we are going to show two similar scenarios. We have used the same methodology. First setup failed and the second succeed. The first setup was silver US dollar. This is how we analyzed the pair. We have used supply and demand combined with AB equals CD pattern. Quick explanation of this principle. We already know that for markets to function it needs sellers and buyers. Supply and demand is all about spotting where buyers and sellers are sitting on our trading charts. However, a retail trader do not have access to current order flow. We cannot spot them within their current position. All we can do is looking back to history, left of our charts, and define previous supply and demand zones with the expectation that in those zones will still exist some serious buyers and sellers. Using lagging supply and demand information, we are making our trading decision based on historical data, not the current definitive data. We also know that what has happened in the past will not necessarily repeat at present time. We have probabilities to deal with. We use price action chart and candle patterns to improve probabilities in our favor. First of all, we noticed a supply and demand chart pattern. This pattern is called rally, base, rally. This pattern happens when we see a rally to a certain zone, followed by a short consolidation, such a rectangle or pennant pattern which forms the base, and then a further rally up again. In this demand pattern, we're looking for demand areas inside a trending market, from where we can see a strong bullish move from. We had the same situation on silver. Price rallied, consolidated and rallied again. Price looks like is rejecting the demand zone. We had also AB equals CD pattern completed in this zone. Candlestick rejection also confirms a bullish pressure. In this moment we can enter a buy trade. Stop loss below the wicks and take profit to the next supply zones. This setup could offer us a 2.7 risk-reward trade. This setup failed even though we had several confluences. We must accept this part in Forex trading. I say often that Forex is a probability game. You must trust your strategy, and in a long run you will be a profitable trader. When we review the trade for mistakes, we see that against our bullish bias was a support that became a resistance. The best decision for bullish bias should have been break above this resistance again. Also, candlestick closure on 4H could have given us more validation for this setup.
Make sure to like and subscribe. This encourages us to make more helpful videos in the future.
The second setup was Australian dollar Canadian dollar. We have used supply and demand combined with AB equals CD pattern as previous example. First of all, we noticed a supply and demand chart pattern. In the drop, base, rally pattern, we are looking for a bearish move towards a demand zone, the drop where we see a short consolidation, the base, before the price turns around and rallies strong. The rally. In this demand pattern, we're looking for the low of the preceding downtrend, from which we can see a strong bullish move back up. We had the same situation on Australian dollar Canadian dollar. Price dropped, consolidated and rallied. Price looks like is rejecting the demand zone. We had also AB equals CD pattern completed in this zone. On 30 minutes time frame, we have a double bottom pattern. Opportunity to enter. We are waiting for breakout and retest. We are marking the potential resistance levels in order to find the best level for our target. This setup could offer us a 2.5 risk-reward trade. As we see price reached the target perfectly. Trust the process and market will reward you.